What's driving real estate right now is not just supply and demand, it's interest rate politics. I'm Dean Lulkin, investing veteran and private credit CEO, here to help you grow your wealth. With President Trump now back in office, markets are already adjusting expectations. In this episode of the Dean's List, I'm going to break down 3 big forces that are shaping real estate in 2025 and beyond, and the historical playbook that tells us what might happen next. We're going to look at Biden's final push for lower long-term rates, Trump's influence on the Fed right now, and what it all means for your real estate investments. Whether that's your house, your REIT portfolio, or your next rental property. In his final year, President Biden tried really hard to stimulate housing. He was job-owning long-term rates lower. Why? To create affordability and unlock housing supply. He rolled out programs like FHA expansion, interest rate buydowns, and encouraging treasury buybacks. All of them were designed to ease financing pressures. The problem, though, prices remained sky high. Lower rates helped some, but we didn't get the inventory boom people expected. Why? Sellers were still anchored to 2 to 3% mortgage rates from the past. That all changed this year. We've been here before. In 2017 and 18, Trump openly criticized the Fed for raising rates too quickly. And in 2019, the Fed blinked, cutting rates even though the economy was growing. What happened? Mortgage rates dropped from nearly 5% to under 3.5%. The move unlocked housing supply and sparked a mini real estate boom. Now we fast forward to this year, 2025, and President Trump is back. Powell's already under pressure once again. Now he says he's independent, but we know historically he will budge. Markets are now pricing in multiple rate cuts, expecting short-term rates to come down. The yield curve initially steepened as Trump was elected, but now looks mostly flat after the 10-year U.S. Treasury yield fell to about 4.3% today. This could mean better mortgage rates are coming, even if not immediate. I do believe the goal of the administration is to move mortgage rates this year, and that could unlock pent-up supply. It's been sitting there on its hands. What does that mean for prices? Well, it could mean very little, or it could mean they move lower. Unless we see consumer confidence move back up and the jobs picture shift into high gear again. Then all bets are off and we could see rising inventory and rising prices, much to the dismay of first-time buyers. Let's look at where the opportunities and risks really are. First of all, home builders. They were ramping up before tariff talk spooked all of the CEOs, and continues to do that today. Builder confidence was climbing back up above 50, an important metric, but has now plunged to very low levels. This could present opportunity in stocks like Toll Brothers and KB Home. Historically, a sustained increase in confidence leads to 15 to 20% outperformance over the next 12 months. Will it this time? We'll see. REITs, highly sensitive to interest rates. These are real estate investment trusts. This is your way of buying public representations of everything from warehouses to apartment buildings to Class A office space, especially the ones with short-term lease durations or inflation-linked contracts. I want you to watch sectors like logistics, storage, and senior living. They tend to rally after the pivots. I'll give you my secret weapon, a little nugget here thrown in. Lending Tree, ticker TREE. I want you to research this company. It is one small public company that could benefit disproportionately if rates fall and the housing market thaws this year. It's a risky bet, but the stock has asymmetric upside for my portfolio. This is the premier provider of leads to the mortgage industry, and the prospects are entirely tied to loan demand. The stock got destroyed during the Fed's hiking cycle and now stands poised to capitalize, in my opinion, on a reversal of that trend. I want you to take a look at it and see if it could be a fit for your portfolio. So what's an investor to do? Well, first and foremost, remember that REITs, real estate investment trusts, and real estate only make up about 2% of the S&P 500 index, and 6% of the same index weighted equally between each of its 500 stocks. Home builders sit inside a consumer discretionary sector, which is only 10% of the index. Regardless of how you weight it, the top 3 home builders together today are only worth about $100 billion in market cap. Peanuts compared to Amazon and Tesla, half of one McDonald's. So if you feel passionate about real estate outperforming this year, you could make some strategic ETF or single stock bets to create some overweights relative to those benchmarks, because owning them outright, you're not going to feel anything from those real estate plays or the home builders. The real estate market in 2025 is all about expectations. If mortgage rates fall, we'll see new inventory, more buyers, and potentially more price volatility. But if inflation sticks or the Fed holds longer than expected, we could get stuck again in low supply and high prices. Bottom line, this is not a passive market anymore. If you want help thinking through your real estate investing strategies, or you just want to grow your wealth without chasing trends, hit subscribe and let's keep going together.